The petrodollar is dead. For 50 years, it funded American debt and kept borrowing costs low. Now it's gone, and somebody still has to buy $36 trillion worth of US debt. Let's see how this is going to end up. Watch this.
The Iran war might have ended the US dollar's dominance. Not in a speech, not in a treaty, in 6 weeks of real transactions that proved the world can buy oil without American currency. That proof didn't exist before February 28th. It exists now. And the bond market, the most sophisticated financial market on earth, started pricing it in before most Americans heard the word petrodollar. For 50 years, every country that needed oil had to hold dollars to buy it. That wasn't a preference, it was the architecture of global energy trade. You couldn't fill a tanker without US currency. That forced demand is the reason America could borrow $39 trillion and not collapse. The reason your mortgage rate isn't 12%. The reason a dollar in your wallet buys anything at all overseas. Not because America's economy is the strongest. Because the world needed dollars the way it needed fuel. Not optional. The Iran war just proved it's optional. By the end of this video, you'll understand what the dollar's power actually rested on, what specifically broke in the last 6 weeks, and what it means for your mortgage, your savings, and the cost of everything in your life. This isn't abstract. This is the plumbing underneath your standard of living. And a war in the Middle East just cracked the pipe. June 1974. Henry Kissinger and Prince Fahd sit across from each other at Blair House, the guest house across the street from the White House. They sign an informal arrangement. The terms are kept secret for 42 years until Bloomberg files a Freedom of Information Act request and publishes them in 2016. The arrangement had 3 parts. Saudi Arabia sells its oil exclusively in US dollars. Every country on earth that needs energy, which is every country, must hold dollars to purchase it. That creates permanent structural global demand. That creates permanent structural global demand for American currency that no nation can opt out of. Saudi Arabia recycles its surplus oil revenues into US Treasury bonds. This kept American borrowing costs artificially suppressed for decades. In exchange, the United States provides military protection, weapons, and security guarantees to the Saudi monarchy. That's the petrodollar. Not a theory, a mechanism. The reason America ran deficits for 50 years without facing the consequences every other country faces. The world wasn't funding American debt out of generosity. It was funding it because the architecture of energy trade required it. Buy oil, need dollars, hold dollars, park dollars in treasuries. The loop ran automatically. Every barrel sold reinforced it. Now here's what happened in 6 weeks. February 28th. US and Israeli forces strike Iran. The Strait of Hormuz closes. 20% of the world's oil supply disrupted overnight. Every country dependent on Gulf crude had a choice to make immediately. Find dollars or buy oil without them. They chose without. The mBridge digital currency platform, built quietly over the last 3 years by the central banks of China, the UAE, Saudi Arabia, Thailand, and Hong Kong, processed real oil transactions in yuan. Not a simulation, not a pilot program, real crude oil, real money, no dollars involved. Iranian oil flowed to China entirely through this system. SWIFT was bypassed completely. The US banking system wasn't in the room, wasn't needed, wasn't consulted. This platform had been in development for years. BRICS talked about it at every summit. Economists debated whether it would work. Skeptics said it was a fantasy, that no alternative system could handle real commodity flows under pressure. The Iran war was the stress test nobody planned and nobody could fake. It worked. In weeks, not years. And here's the part that doesn't reverse with a ceasefire. Every country that just purchased oil without the dollar remembers the experience. The infrastructure stays built. The relationships stay formed. Saudi Arabia recycles its surplus oil revenues into US Treasury bonds, keeping American borrowing costs artificially suppressed for decades. In exchange, the United States provides military protection, weapons, and security guarantees to the Saudi monarchy. Now watch what the bond market did, because the bond market understood this before anyone on television explained it. March 1st through 9th. Here's the rule that's held for 50 years. When geopolitical fear spikes, investors buy U.S. Treasuries. Prices rise, yields fall. It's the safe haven trade. It happened after 9/11, the Iraq War, and when Russia invaded Ukraine. Universal, automatic, reliable. When the U.S. struck Iran, the 10-year Treasury yield rose, not fell, rose, from 3.93% to 4.2% in days. The deepest market in the world decided U.S. debt was not where it wanted to be. That's not a glitch. That's the bond market telling you something structural has changed about how the world views the dollar. The safe haven trade broke during a war. That hasn't happened in modern history. The knowledge that it works under real pressure with real volume in a real war, that's permanent.
Hey, real quick, if you're watching and what you're watching, you're understanding that it's debasement. It's an actual debasement story. The dollar's structural support is eroding, and that just has an absolute direct impact on your purchasing power. The Bitcoin and security bundle covers what actually preserving purchasing power during a cycle like this looks like and what it means, how to hold assets that survive currency decline, and how to do it safely without getting trapped the way that most people do. I do not know how long I'm keeping it at this price. If you want to invest in crypto and do it safely, the link is below. So now let's get back to the channel, the video. Yeah, you get it.
You don't unprove a proof of concept. You can't ask the world to forget the door was unlocked. Foreign investors now hold 32.4% of outstanding U.S. Treasuries, the lowest share since 1997. At the height of the financial crisis, that share was over 50%. This is an 18-point structural retreat from the buyer base that kept American borrowing cheap for half a century. JP Morgan research put a number on what this means. Every 1 percentage point reduction in foreign holdings relative to GDP lifts Treasury yields by more than 33 basis points. The connection to your borrowing costs rising isn't a forecast. It's already in the data. Treasury auctions all drew weak demand in late March. The buyers who showed up reliably for 50 years aren't showing up the way they used to. The war was the stress test, but the foundation was cracking before a single missile. Saudi Arabia's current account surplus was over 50% of GDP in the 70s. Today, it's 0.5%. When there's no surplus, there are no petrodollars. The math canceled itself. Saudi Arabia joined BRICS in January 2024. 9 of the 10 largest oil producers are now in a block building financial infrastructure to bypass the dollar. Saudi Aramco is settling sales to China in yuan. Vision 2030 is the Saudi monarchy formally declaring it will not tie its future to a single superpower. The arrangement Kissinger built in '74 doesn't describe the relationship anymore. It's over. Forced demand for dollars was never about trust. It was never about the American economy being strong or weak. It was about architecture. The architecture required every country to hold dollars for energy. When that requirement breaks, the demand breaks with it. The world found an alternative, and the alternative works. The Iran war didn't create it. It proved it under fire. That's the difference between a theory and a fact. De-dollarization is now an operational reality. The chain from the Strait of Hormuz to your kitchen table. Because this isn't macro for the sake of macro. This is the pipe underneath your cost of living. When foreign demand for dollars drops, the dollar buys less overseas. When demand for treasuries drops, yields rise. When yields rise, your mortgage rate rises. The 10-year is above 4% right now and rising. During a war when it should be falling. That's the shift in real time. When the government pays more interest on its debt, the deficit widens. Then more debt must be sold. Then yields rise again. The petrodollar was the mechanism that kept the spiral manageable. Forced demand, automatic buyers. That automatic buyer is leaving. Not threatening to leave, leaving. 82 billion in 5 weeks. The bond market already priced it. Your mortgage rate already reflects it. The government's interest payment already compounds. Britain, 1945. The pound sterling, world's reserve currency, 81% of global reserves. The British Empire created the forced demand. Every country trading with Britain needed pounds. The architecture was automatic. The empire contracted. The forced demand contracted with it. Suez proved Britain couldn't project military power and defend its currency at the same time. Fighting a war drained the reserves that backed the pound. Slow enough that most didn't notice. September 28, 1976. Chancellor Dennis Healey at Heathrow Airport, on his way to an IMF meeting. A message reaches him. The pound is collapsing. He turns around, applying for the largest IMF loan ever requested. 81% of global reserves to IMF bailout. 31 years. The British people didn't get a memo. There was no announcement. They just woke up one year and the groceries cost more. Then their savings bought less. The decline of the pound wasn't a headline. It was a texture. A slow change in what life felt like. And by the time the average family understood what had happened, it had been happening for 20 years. Your grandkids aren't going to read about the day the dollar lost reserve status. There won't be one. What they'll read about is a war in 2026 that forced the world to build something it had been talking about for a decade, and how after that, slowly, then faster, the countries that used to need dollars just stopped needing them, and how the borrowing got more expensive, and the printing got heavier, and the prices never quite came back. You're living in the early part of that story right now, the part where most people haven't noticed, the part where it still feels like temporary disruption. The British felt that too, for about 15 years. Then Healey turned around at Heathrow, and the word goodbye was in the Wall Street Journal. The door got kicked open 6 weeks ago. Nobody's putting the lock back on.